Hello, and thank you so much for viewing this recording of our 2025 third quarter economic and market review, hosted by the Investment Committee of Curo Private Wealth. I am Atrisa Roberts, COO and a partner here at Curo, and I am joined, as always, by my partner, CEO Ann McCabe, also joined by our investment and planning associate, Xander Cochran, financial advisor, Manny Carranza, and then the newest member of our committee, financial advisor, Carol Castillo. So we will start this presentation like we typically do. So we will begin with a review of the economy year to date. Now, we continue to experience economic headwinds, including tariff uncertainty, geopolitical tensions, slowing of the labor market, and most recently, a shutdown of the federal government, which as of the time of this recording has now been ongoing for 3 weeks. The economy has reaccelerated and corporate earnings continue to see strong growth. AI investment and spending by the highest income consumers are driving economic growth, but we will note that excluding AI investment, GDP growth has been mostly stagnant year to date. In spite of these headwinds, US markets continue to climb to new all-time highs, shrugging off uncertainty and a slower labor market. In markets, it has been a strong year for equities across the globe. The broader US stock market climbed to new highs fueled by corporate earnings, especially among technology companies. Emerging markets and developed international have outperformed the US significantly year to date in all sectors of fixed income, along with commodities, and the US real estate have also found positive returns through September 30th. Now, to dive in more into the markets, my colleague, Carol Castillo, will review.
Thank you, Atrisa. In the following slide, we will address market concentration by isolating the top 10 companies driving the S&P 500 index. In the first chart on the left, we have forward PE ratio, which indicates how much investors are willing to pay for each dollar of a company's potential earnings over the next 12 months. The green line indicates the top 10 companies in the S&P 500, the blue line, the remaining 490 companies, and in gray, the index. It stands out how the top 10 companies diverged in the late 90s during the dot-com era and today with the AI industry boom. The top 10 companies today are trading at around 30 times earnings per share versus in the late 90s, the top 10 companies were trading more expensive at 44 times earnings per share. The 30-year average is 16.8 times. The second chart on the right, we see the weight of the top 10 companies in the index. Today, they represent 40.4% of market cap and 32.5% of earnings. With this data, we can infer that yes, there is market concentration, as in the late 90s, yet we can argue that today there are fundamental reasons for market concentration, such as profitability. In the following slide, we continue with market concentration, but in a different visual. We take a step back to see how the top 10 companies in the S&P 500 have evolved since 1985 by decade. The colors indicate the top 10 companies by market cap and by the year they first appeared in the index. From 1985 to 95, only 5 of the top 10 original companies remain on the list. A decade later, only 3. By 2015, only 2 remain. And finally, in 2025, none of the original companies are on the list. This visual allows us to see how, as time lapses, new leaders emerge and former ones fade from the top 10 list. And now we take a deeper look at valuations. In this graph, we have the S&P 500 forward PE ratio for the last 30 years. A higher P/E ratio tells us that investors expect strong future growth or that stocks are becoming more expensive relative to their earnings outlook. While it's currently sitting at around 22.8 times, this level is above the 30-year average of 17 times and remains slightly lower than its peak in the late 90s during the dot-com bubble. We are keeping a close eye on this metric as it does suggest that companies in the S&P 500 are trading at a slightly higher price as historical data. And I will pass it on to my colleague, Manny.
All right, thanks, Carol. So I'll be going over our recent portfolio changes. So we haven't made many changes since our last market update, and that's very intentional. As many of you probably heard in our meetings, our outlook right now is cautiously optimistic. So on the cautious side are stock valuations, which is what Carol went over. So particularly the S&P 500 valuations are pretty stretched. We've seen prices move well above historical averages, which means that the market is pricing in a lot of good news already. But on the optimistic side, the Federal Reserve has been hinting at upcoming rate cuts, and fiscal programs like the OBA, or One Big Beautiful Bill Act, which is a mouthful, continues to inject money into the system. That combination of monetary and fiscal support tends to boost the animal spirits or enthusiasm that keeps investors willing to take risk. Our neutral stock to bond mix is reflective of our balanced defensive outlook along with some growth. So on our next slide here, it's just referring to politics and investing. So it's hard to believe that it's been less than a year since the current administration took office. It feels like much longer with everything we've seen in the headlines. So what you're looking at here is a chart of the S&P 500 going all the way back to 1944. The blue sections represent the years that Democrats were in office, and the red sections represent the years with the Republican in office. And the reason we show this is because over time, you can see that the market has continued to grow regardless of who's in the White House. And that's a powerful reminder that politics and investing don't move in lockstep. So as far as our investment approach, we don't make changes to portfolios based on short-term political headlines or election results. Instead, we focus on the same things that have always mattered to us, which are staying invested, keeping diversified, and letting time in the market work in our favor. Our job here is to help you stay focused on your long-term goals, not the daily noise, no matter who's in office or what's driving the headlines that week. So next, we have Xander.
All right, great. So next we'll look at the economic side of things. And as we always like to look at our economic dashboard, which shows 5 different aspects of the economy from where they are from a positive to negative territory. The first one being monetary policy. This is the highest of the 5 dials up towards the positive territory, is really around what the Federal Reserve Bank is doing with interest rates. They recently cut interest rates for the first time this year, and likely we'll see 2, maybe 1 more cuts for the remainder of this year. But that extra monetary stimulus could definitely help both stock and bond markets and be accommodative overall for the economy. Next, we have manufacturing, which has struggled for quite some time, kind of staying towards the lower end of neutral, as it's struggled to stay in expansionary territory since 2022. The consumer next, we have, this is one shift from last quarter where it moved and downshifted slightly, still within the neutral range, but moved down a little bit closer to the negative. We still have consumer balance sheets overall remain relatively healthy, although delinquencies have moved higher. We're seeing this with student loans and with cars specifically. We're also continuing to see a bifurcation within the consumer, where those at the higher end of the income spectrum are still earning and spending well, while those at the lower end are struggling a bit more, especially with the more recent tick up with inflation as prices move higher. Next, we have the housing market, which is the only one solidly into the negative territory, as housing costs have continued to remain elevated, especially with elevated mortgage loan rates as well. That's come down slightly, but not too much. Also, particularly here in the DMV region with the government shutdown, that seems to be affecting it even more so. But overall, across the market, we see a delay in houses, how long they're sitting on the market, the list price coming down, and overall not a great market for either side, the buyers or the sellers. And then lastly, for the labor market, wanted to highlight this one in the box there as it's probably the most important right now. This has also come down within the past quarter, still within the neutral range, but we're definitely seeing a downshift and slowing within the labor market. One thing to note is with the government shutdown, we did not get the most recent job numbers. So that data aside, which we're missing over the past 3 months prior to that, the average payroll growth was at 29,000 per month, which is very much slowed compared to more past years. In the next slide, you'll see that a little bit more drawn out. So you can see during 2021, 2022, when we had the effects of COVID still in the economy, there was a lot more demand for labor market, supply chains being a big effect of that. We had a lot of increase in payroll numbers over the years. Since then, that's come down pretty substantially. And you can see even more so within the past year, since 2025, those numbers have come down pretty dramatically with the average 3-month being at 29,000. We do think that there are multiple different factors affecting this, but overall, we're seeing a slowdown. One of those factors we would say is artificial intelligence, as companies are looking to utilize that as a source of productivity instead of labor markets. But we'll see how everything shakes out. But it's definitely one factor that we are watching very closely, and the Federal Reserve Bank is also looking at very closely as they're making decisions for the next rate cut. Next, we see the other factor that's affecting the Federal Reserve Bank decision on rate cuts, which is where inflation is. And we've seen a reacceleration in recent months for inflation, which is really from the effect from tariffs. As tariffs are increasing the cost of goods, you can see that it's kind of hard to see, but the core goods in orange that had been neutral or negative in the past, that's now in positive territory, which means that core goods are now adding to inflation overall. And that's really where we're seeing the tick up in inflation. We think it may take some more time before tariffs really are fully impacted in how they're affecting inflation. So expect that inflation will move higher before eventually it would move closer down to the Fed's 2% target. In the next slide, we see the effects of tariffs as well. So this is looking at the long-term historical rate for tariffs. And you can see back since 1900, rates were much higher, but over the decades, they came down much lower, where the most recent couple decades, it wasn't even above 5%. Switch over to 2025 this year, we saw tariff rates move all over the place, but really have moved significantly higher. We saw a peak at around 30% in April. Since then, that's come down to about 19% as of September 30th. But one thing to note here is that's the statutory rate right now, which is if you placed, or if you did imports today from other countries to the US, that would be the rate averaging across different countries from where they're originating. If you look at the year-to-date total number, that's lower for the effective rate at 6.2%. So that's kind of cumulatively what's been factored in this year, just as imports are changing over time, and expect that number to tick higher and move up towards that 19% rate over time, assuming that stays static, which probably will not. But all that to really say that inflation is still being impacted and tariffs are not fully factored into the economy right now. And the last slide I'll go over is really around AI spending. And this chart here is looking at its contribution to real GDP on a 2-quarter rolling average. And you can see this year, for the first time, we're seeing business AI spending surpass consumer spending as terms of what's contributing to the economy and the economy's growth. We expect that it's probably going to continue as AI infrastructure spending is continuing to grow and at a fast rate, while the consumer is struggling a little bit more overall, and that's come down a bit. But there are still two real main drivers for what's behind the economy. And this picture really shows that. One, it's artificial intelligence, investing in that, as well as the consumer, but really those at the top end of earners for the consumer that's really driving the economy. And still on the AI topic, which is a hot topic, I'll pass it off to Anne.
All right. Thank you, Xander. So speaking of AI has become one of the most talked about themes, not only in the technology space, but certainly in the markets and in the broader economy. And on this slide, we're looking at capital investment, which is driving AI and its impacts on the overall economy. So on the left-hand side, we can see capital spending by the 4 major hyperscalers, and that chart, which really just looks parabolic in terms of the amount that they're investing and spending on AI. So in 2024, you can see that capital expenditures surged past the $200 billion level, which was an increase of about 65% year over year. And that growth is expected to continue. An interesting dynamic, though, is how the expenditures are being funded, which is through cash. So on the right-hand side, we're looking at, since the launch of ChatGPT, how much industrial production, specifically around computer equipment, communication equipment, and semiconductors, has increased in the US. And that is not only just an investment in AI, but also the passing of the CHIPS Act, which happened in 2022. But this really gives a good sense for the broader impact of AI on the overall economy. And as we always love to do, we like finishing off our presentations with zooming way out and looking at stocks over the long run. So if this is your first time tuning in, this is one of our favorite charts to show, showing stocks versus other asset classes literally over 200 years, and importantly, adjusted for inflation. So if you invested $1 back in 1801, that $1 would have grown to over 2.6 million adjusted for inflation. So as Professor Jeremy Siegel likes to say, stocks are the most volatile asset class in the short run, but the most stable in the long run. And we really like showing this chart because it reminds us all that if we are interested in growing our wealth and really trying to maximize our returns, stocks historically have been the best asset class to do that. And then just to wrap, the other thing we love to finish our presentations with is a reminder of where we like to live and how we like to work with our clients at Curo. We like to live where these 2 concentric circles come together with what matters to you and what we can control. And we try really hard on a daily basis not to spend energy stressing or worrying about things that are outside of our control. And we could certainly name a lot of different items and aspects that are outside of our control that may be causing worry and concern. So if you do have any questions or want to talk more in depth around your portfolio or anything that's top of mind, please always feel free to reach out to us. Our info@curoprivatewealth.com reaches the team, and we're happy to chat further. But thank you so much for taking the time to watch this. We hope it was helpful. And our next market review will be a live webinar, so be sure to tune in to that. We will send more information when we have that date booked. So thanks again.